Hello and welcome back to our Invest Ed vidcast series. I'm Chris Sabula and I'm here today with Mark Armbruster. Warren Buffett recently celebrated his 90th birthday. Known as the Oracle of Omaha, he's undeniably one of the most successful investors of all time. But, as the financial media has pointed out, his Berkshire Hathaway's stock performance has recently lagged the market. Mark, has something fundamentally changed?
There are some disturbing trends. It's certainly true that we're in a very narrow market currently, where just a handful of stocks, including Google, Apple, Facebook, Microsoft, Amazon, Netflix, and Tesla, are driving the vast majority of the gains in the overall stock market. In fact, the top 5 stocks now account for over 20% of the value of the entire S&P 500. And that's a record that eclipses even the tech boom of the 1990s. And even with the market at all-time highs, 77% of the stocks that make up the Russell 3000 index are trading 10% or more below their 52-week highs. However, all of that being said, it seems unlikely that anything is fundamentally different in the stock market. We've seen periods like this in the past, and eventually they do pass.
That's certainly the common wisdom. Take a long-term approach, don't time the market, but how long do investors really have to wait? Or if this is going to be a long-term trend, shouldn't we be making changes to capitalize on that trend?
Making changes in your portfolio to invest in just the best recent performers could prove lucrative in the short run, but it likely will result in heartache over time. Periods like the one we're in now come and go. The closest analog is the 1990s, when technology stocks dominated the market and generated huge returns for many years. Unfortunately, the subsequent market decline that began in the early 2000s took a huge toll on those who used such an approach. Large-cap growth stocks, mostly driven by the technology sector, earned an annualized return of 20% during the decade of the 1990s, but they lost an annualized 4% during the following decade. In effect, the tech-heavy NASDAQ Composite Index fell 78% from its March 2000 high to its low in October of 2002. Today's market may not be that extreme, but there are certainly signs that today's most in vogue stocks are trading at lofty levels and may be due for a fall. Rather than chasing the performance of the best stocks, diversification is your best bet for long-term success.
Diversification seems a little outdated currently. Being diversified over the past decade would have cost investors a lot of money.
It's certainly true that diversification has become sort of a quaint old idea that now seems hopelessly outdated. However, market cycles come and go, and what is hot today will look equally hopeless when the current cycle gives way to the next. The hardest part of all this is that these cycles are unpredictable and can continue for many years. To answer your previous question, a lot of investors think of 3 to 5 years as the long term. However, 3 to 5 years is really just statistical noise in the world of the capital markets. Cycles that appear unsustainable can continue for 10 years or more. And this eventually lulls us into believing that something has permanently changed and that we need to adopt new approaches to investing. But for those who are truly long-term oriented, riding through periods of underperformance with tried and true strategies will still offer the best chance of building long-term wealth.
What does diversification look like to you?
It may mean spreading assets to other asset classes, such as bonds, real assets, or even alternative investments. However, even within the stock market, diversification is important. Buying stocks across various industries, sectors, and geographies will become increasingly important through time. Value stocks, smaller company stocks, and international stocks have all lagged domestic large capitalization growth stocks lately, but their long-term track records are undeniable. It may be hard to remember, but these other segments generally have trounced the returns of large cap growth stocks and the overall stock market over longer periods.
Right, and that value approach has always been Warren Buffett's go-to strategy.
Yes, and that's why he's underperformed by so much lately. His value stocks have struggled. But over the really long term, Buffett has dominated the stock market. His annualized returns since 1965 have been twice that of the overall market, and $1,000 invested in Berkshire Hathaway stock in 1965 would be worth more than $27 million today. Not many stocks or investors can make such a claim. So focusing too much on performance over shorter periods would likely have caused investors to abandon Buffett's strategy at various points over his multi-decade investment career, and this would have ultimately come at the expense of tremendous long-term performance. And diversification is no different. Such a strategy looks foolish today, and it looked foolish during the decade of the 1990s, but it would have saved a lot of investment losses when the market turned in the 2000s, and I suspect something similar will happen during the 2020s.
Why is that?
Because market valuation dynamics point in that direction. Warren Buffett's best returns came from investing in value stocks when they were the most beaten down, during the late 1950s to the late 1960s, and again from the mid-1970s to the early 1990s. By some measures, value stocks are even cheaper today. And so while investors have pushed up the valuations of the most expensive, least profitable stocks over the past decade, it defies human nature to believe that this will go on forever. Getting the most for our money by purchasing the stock of profitable companies at reasonable prices seems much more rational than buying high and hoping to sell higher.
Yeah, but how long will we have to wait to see this play out?
Yeah, that's the tricky part. No one knows for sure. It seems like the stock market is ready for a change in leadership. Tech stocks are showing signs of faltering some days, but these cycles can continue for some time, as I indicated before. The stock market appeared very overvalued in 1996. That was the year that Fed Chairman Alan Greenspan gave his irrational exuberance speech, opining on the overinflated value of the stock market. However, stocks continued to rise for 4 more years, and their annualized return over that 4-year period was greater than 20%. The market may not behave the way we want, or in any way that we can predict, but its returns over longer periods have proven reliable. There's no reason to believe that has changed, but the best way to earn those returns over time is with a diversified portfolio, even if that appears outdated in certain market environments.
Some markets can make even investment greats like Warren Buffett look foolish, but sticking with a long-term oriented, tried-and-true strategy still makes the most sense for building long-term wealth. Thank you for joining us today. Please join us again for upcoming episodes of our Invest Ed vidcast series. As always, feel free to get in touch if you have any questions about this or any other investment topic.